we're staring down the barrel of a impending recession, or we're getting ready to achieve that soft landing. And now may be a really good time to get into commercial real estate. Well, we're going to be talking about the fundamentals today. Also, there's some near-term events that have been happening over the last couple of weeks. First, a piece from the Bureau of Labor Statistics. We have a new CPI print today. We want to get into that. Rent spiked. How does that make sense? It spiked by about 5%. We're going to get into the details of how CPI is broken down once again. And then from institutional property advisors, interest rates are trending lower, paving way for invigorated commercial property investment. Then from MSCI, global commercial real estate is showing signs of recovery. Onto Moody's Analytics, market meltdown leads to a spike in refinancings. And then from the National Association of Realtors, NAR, commercial real estate market insights, July 2024. While the market awaits the interest rate cuts from the Federal Reserve, commercial real estate is also on hold. We're going to be talking about all of this and a lot more. So, you want to watch the whole episode. Subscribe to the Great Capital YouTube channel. Like this video. Leave us a comment. Let's get into it. Welcome back to the Gray Report. Joined again, Vice Director of Communications and Marketing, producer of the Gray Report, Dr.
Hello.
Matt Boss Nodal. Matt, how are we doing this week?
Hey.
Better than last week? Because
Yes.
last week, we were, is the economy crashing, interest rates are way down.
I
How
think
we feeling?
I think that the economy, and the market hasn't really fully recovered, I think, from the turmoil, but it's still in another interesting week. Last week was pretty good just because there's a lot to talk about.
Yeah.
And this week is still interesting because what it is, the market, and I think CRE markets have processed a lot of what has happened, and nobody's scared yet, I think. At least
people were scared for a day or two there. I think they saw markets just kind of collapsing by Japan, but then it was a quick recovery.
Mm-hmm.
And even though there may have been some fear for a potential recession, which some of that has been pushed to the side. There's some reasons that we can get into, not necessarily on the agenda that you should be watching for a recession for technical reasons, but commercial real estate investors, when they saw the 10-year fly down past 4%, getting down almost, I think, 3.9%. Last time I checked, it was still below 4%. That was a huge milestone in itself. And the idea that the Federal Reserve is almost certainly going to reduce the federal funds interest rate at the upcoming September meeting. We talked about last week, upcoming Jackson Hole conference and speech. It's going to be coming up later in August to discuss kind of a little bit more of the framework and the thoughts of the Federal Reserve, creating a really good, platform and runway for those rate cuts.
Yeah.
The conversation is moved beyond whether we will see rate cuts this year, but it's to what extent. Will we see just the kind of the standard, what is mostly anticipated 25 basis point reduction, or do they do something bigger, 50 points, 75 basis points, or do they just wait to that November meeting 2 months later and just do another 25 or so at that point?
Well, you got to call for 50, like all the prognosticators. You got to expect 50, but then you're really going to get 25.
Well, I guess that's folks that are just pushing on the Fed. They want a little bit more.
Yeah.
But I think from where we're standing today compared to where we were last week, again, we had the CPI report that came in, and generally, it seems as though the issues related to that, Japanese yen carry trade, a little bit more isolated. The Bank of Japan kind of reversed course, lowered their interest rates back down, kind of settling the market. And again, no kind of major tripwires. Had that weaker jobs report that came out last week with unemployment inching up. Best indicator for a recession. And the other piece, this is just getting into the technical side of why one might be anticipating a recession, is looking at the yield curve. And that we are on the precipice of reinverted and having a more normal, positive, sloped yield curve. So if we look at the yield curve, and obviously we've been mostly negative, really beginning in 2022, deeply negative throughout 2022 as we started really increasing interest rates. But as we zoom out, just from historical context, which again, I don't necessarily think that what has happened in the past will happen again, but I think we're in a little bit of an unprecedented economic environment. But what has happened for every single the last several recessions as the yield curve has inverted. And then once it reverts, typically because the Fed lowers the interest rates because the economic activity is slowing down so much, it triggers a recession or a recession occurs. So looking back, whether that is from the mid 80s, go back to the 90s, we had the yield curve inverted, it reverted again, and then recession. Back after the dot-com bubble, yield curve inverted, reverted, and then recession. Back into the GFC, the yield curve inverted, reverted, and then we had a recession. All happens within about a year or so. Technically, it even happened relative to COVID in 2019, prior to the pandemic. Again, one could argue that they're unrelated, but the world continues to prove itself out. A quick inversion of the yield curve with a recession, really related to the COVID pandemic. But again, all of the last several recessions, we've had an inversion and then a reversion, which then has somewhat triggered it. Now, again, I don't think we're necessarily in the same situation as all of these previous examples, because we're not really seeing a credit crunch like we did when those other recessions took place. But that, combined with the Somme rule, certainly is having some a little bit on edge. But really, that's only from a technical standpoint of there's some general rules out there when a couple of these things happen. This is what I was thinking of too.
Place. Like when we're talking about 10-year registry, so this is very sloppy metaphor, but is it basically saying, like, I think that the next 2 years is better than the next 10 years? Is that what I mean? If people are buying, I'm not really.
They don't have really confidence in the near term.
They don't have confidence.
You might go into a longer term bond because it's going to be more secure.
Yeah,
you're flying to safety. You don't necessarily want to put your money in a short term, bond having expire in a year. You might be in a recession where you're going to put that money, and you may have to be reinvesting at lower rates. So people going out further out on the maturity curve. That's what typically leads to the inversion, but also monetary policy. So in this case, when the Federal Reserve increases the Fed funds rate, by fiat, getting it up to 5.25%. Well, the 10-year, when they did that, the 10-year was in the 3% range, and so it would have stayed. Never organically, because the Fed's always, the Fed was keeping the Fed funds rate in the shorter term maturities artificially lower for much longer than they should have been low. Because remember, we were seeing inflation when the Fed funds rate was zero.
Yeah.
And interest rates, so all the short term rates were zero. The 10-year Treasury was below 1%. I mean, it got down to 0.49%.
Yeah.
And so, as the 10-year was naturally rising as it does in the market, the Federal Reserve was like, oh crap, we have all this inflation. We have to slow down the economy, and they used one of their primary tool, which is increasing interest rates, regardless of wherever the 10-year, which basically forced the curve to invert.
Okay. Yeah, and what I'm also noticing, and it maybe helps explain it, especially as it relates to inflation and the ways that the federal funds rate has been shifted in the past 4 years. This inversion is a lot longer than some of the other ones. At least going back until the 80s, you don't see the length of a yield curve inversion as that long now. I wonder if it does have something to do with inflation, because that was an inflationary period during the 80s, and that was the time.
Deeper, longer, and deeper.
Yeah,
that's for sure. Related to interest rates, related to all this is CPI, because again, that's what the Federal Reserve is going to be looking at. So general, big picture, man.
CPI year over year is lower. It increased. It increased 2.2% on a month-to-month basis, which is a little bit sad because last month we had monthly deflation. Yeah. But still, the year-over-year number finally crossed the 3% level, and that's like the ideal condition. Maybe it's a goal they're shooting for, and I wonder because
somebody just came up with 2%.
And it's true. I think someone wrote it in like a paper a long time ago, and I was like, "Wow, it sounds like a good thing to shoot for."
Yeah.
Because there's no, the Fed said it's a goal, but there's no like hard and fast. Like when it's X thing, we're doing this. They always leave themselves a wiggle room. I mean, geez, given how generic and vague they are on a daily basis, it's
it's an average of 2%.
Yeah.
That was a change a couple of years ago. Like,
yeah.
Going for the average, not necessarily right at 2, or we want to be close to 2. We don't have to be absolutely
yeah. Wouldn't it be nice if it was 2?
Wouldn't it be nice?
So I think that they give themselves wiggle room probably because they try to overshoot it in a way, but it much more seems like a thermostat where like you'll set it, it'll run for a little while, and then it'll get a little higher, then a little lower.
That's the way it should work. It wasn't exactly working a couple of years ago when we had high inflation at low zero interest rates. One thing about this, Matt, is that the CPI that's interesting, and it really is the data that I think the Federal Reserve needs for further confidence to reduce rates. Again, if this was off, if we had seen massive, if we saw a strong number, more inflation, they may have been more cautious. That gives them the green light to be able to lower interest rates. But at the same time, striking the balance of it's not like everything is falling off a cliff and we're seeing major declines across the board. And just extreme slowdown.
That was one of the takes that I saw. It was an optimistic take on the economy. Like, well, if it was a really deflationary again, then you got to start worrying about the economy in general. So
really more of a Goldilocks number. But one, the real driver of inflation this month has been shelter and rent, which is surprising. But not shocking to listeners of the Gray Report. If you know how CPI is calculated, we've debated many times on this program about is that the best method? It's taking a survey, a non-same store survey of renters predominantly in single family homes. Even though they call it owner's equivalent of rent, they are actually talking to renters.
It would be much better if they just talked to NAR or some organization and was like, "What's your sales price?"
Yeah, there's so many other ways. Yeah. In the one way, so they're marking again shelter up 5% year over year, but we know that rent growth has not been 5% year over year. Maybe we're a little bit under 2%. And so the only way to me that there's two reasons why this makes sense. Or I'm trying to explain. I'm trying to help the BLS out here. One is that again, they're not just looking at new market rent leases. So they're not going to apartments.com to see how much people are charging because you could only sign one lease that's marketed. That doesn't mean that everyone's paying that.
Yeah.
But everyone that has been living in an apartment over the last 4 years through the pandemic, through the rent increase that we saw in 21 and the first half of 22. If you were living there, you might not have been renewed at that higher rate. And so it's taken time for all of the leases at properties to kind of absorb a loss to lease, kind of moving up to closer to that market rate.
Yeah.
Which means that, okay, maybe the market rates have stayed flat, but everyone else is finally paying, closer to that market rate. And additionally, if they are surveying more single family homes that are single family rentals, that rent growth has been more robust than, large multifamily properties
that's
that
true.
Are professionally managed.
Yeah.
So again, they don't explain it that well at the BLS, but because it's a big head scratcher. Because again, if you are tracking like we do on a weekly basis, rent movements across the country for professionally managed large apartment communities, which is kind of primary we look at. We look at a little bit of everything now. 5% really jumps off the page. That's kind of double what the nation is experiencing.
In some cases, more than double. 5% is also well off the long-term average too. Yeah. So you think that even if you're talking about going back to whatever the CPI normal is, then it's got a couple percent to go. And objectively, from our perspective, I think it will get below the long-term average because that's what we've been seeing in the apartment market for market rate units. Just a matter of time, and it's very weird. Like this is when I noticed that apartment rent of primary residence actually mildly increased on a month-to-month basis according to CPI. I was like, well, that's the exception that proves the rule. Like we know the long-term trend. If this happened 3 months in a row, then I would be pulling my hair out. But right now I'm like a little bit comforted that like, all right, we didn't know everything, but dang, are all of these other categories are like really bang on. And I agree with you. I think this is a little bit of a Goldilocks report. I did take note of all of the news articles from Washington Post and Wall Street Journal that it's teeing up rate cuts or it sets stage for the rate cut. It keeps rate cuts on the table. I don't think that it is an alarm bell. I don't think that it will lead them to lean towards a higher rate cut, but it certainly supports it. And I was listening to, it was some Bloomberg or
Some
CNBC
guy.
or some guy. Yeah. Some expert was talking about how that August, their Jackson Hole meeting, that's written months in advance. And so what were they thinking and what were they depending on? And I think it was the same long-term trends that the CRE market
Maybe
has also been
they have an outline, but I mean, like they know how things are moving,
Yeah.
and they probably, I mean, the discussion about around the September rate cut has been in the lexicon. People have been talking. It has been talked about for quite some time.
Yep.
I mean, it's been one of the targets for months now. When people are like, okay, no, we're not going to get the 6 rate cuts that were called for at the beginning of the year. Maybe one in September. I mean, we also July.
Oh, we can bring up that next article actually deals with that. That was a helpful showcase of how the CRE market intersects with the rate cuts. And I know it's like it goes without saying a lot, but I sometimes I feel like myself spinning out into like, oh, what is Jerome Powell thinking? It's directly affects mortgage rates for apartment buyers and for homeowners and for housing, and it is something that the CRE market has been thinking about and predicting, I think, for the last few months. And
there's a lot of dry powder on the sidelines ready to get in. And the idea that we've been talking about for quite some time is just seeing a great opportunity to buy commercial real estate assets at depressed prices as interest increases your returns, the lower the interest rate, and so people can pay slightly higher prices, which decreases cap rates. And I think we're already beginning to see that. I've read the conflicting reports, Matt, about kind of where cap rates are. And even in this article, people are talking about how a lot of cap rates are on, multifamily, kind of are at the kind of like around the 6% range, which really seems to be a target acquisition cap rate for a lot of buyers. But unless it is a severely distressed, older vintage workforce housing kind of failed value add project, the newer, nicer properties are trading closer to a 5 cap. And that is being more crystallized by the transactions that Blackstone and KKR have executed over the last several months. Blackstone's selling some properties to another group, again, for right around a 5 cap, kind of plus or minus. It's a little opaque. We don't know all the details, but that's what we've heard communicated. And so the market is kind of holding that floor in a sense, and as interest rates fall, that's just making those acquisition opportunities much more feasible, returns going up. And a sense that all the good deals are going to be past us. Not that we're out of the woods. We are appearing to enter kind of this Goldilocks moment in a way, or feeling. It looks like we could go full steam ahead. There's still black swans circling. It's something could happen. The Bank of Japan carry trade is an example of that. But I just have to remind everybody that is just normal. Like anytime, there's always there's always some black clouds on the horizon, and the black swan could emerge at any moment. And while maybe we're more vulnerable and sensitive, certainly sensitive, because everyone's been waiting,
that's what I keep
anticipating. But really, if we look at the fundamentals, I don't see any reason to be like more concerned than any other kind of normal economic period. And especially, I guess, if you think that we're either early cycle or late cycle. If you think that we're actually just still at the late cycle and we haven't had the last shoe drop and we still need that recession and the economy needs to go through that cathartic period, then you're waiting for the next foot down. But if you are of the belief that we had a recession in 2020, we sort of had a technical recession that's not official, a year and a half ago.
That's what, looking at the technicals and looking at the trend lines, it makes you feel like there's no free will. That people aren't actively, the Fed's trying to prevent this. People are trying to prevent it. But, I guess if you just rely on whatever happened in the past was going to happen in the future, there's still it's not a perfect sample size either where we're tracking these things. So
and again, all of our analogies and analogs are all on just starkly different economic conditions. And the pandemic was so extreme, and the government intervention was so extreme, and the monetary intervention was so extreme. And we talked about kind of the time, the x-axis kind of time dilation and expansion of 7 years of growth in 1 year, and then we're kind of paying for that. And
I mean, look at consumer sentiments. They're not happy, and for the most part. I mean, it's getting better, but like,
they're
geez,
confused.
yeah,
Every couple weeks, Matt. I mean, again,
that's a good point.
I mean, 4 weeks ago, we were like, okay, we're kind of good. Maybe we should have interest rate cuts in September, but we're not sure. Everything is looking okay. Then all of a sudden, Bank of Japan raises their interest rates by 25 basis points or whatever.
Yeah.
And the whole world economy is going to come crashing down, and we're going to see deflation and emergency rate cuts.
Yeah.
And then literally days later,
I know.
Weeks later,
insane.
it's like, oh yeah, well the VIX may have spiked to 60 some points, but we're fine. And that's just a Japanese carry trade that's being unwound, and the jobs report wasn't as bad. I mean, it was still positive, and now we're back to Goldilocks. It's fine.
Yeah, I know.
So
it is.
As a consumer, as a normal person, as a person who follows this on a daily basis, it's confusing and hard to keep up with.
Yeah.
If I'm a normal consumer living my just normal life, just the confusion itself would be like, this economy sucks.
Yeah.
It's not a good economy. You can't make heads or tails of it. And that indecisiveness, the inability to make decisions, the inability to plan, does have a negative and a downward economic effect because it puts off decisions.
That's a really good point. Oh man, I get to segue to the thing it was just a paper that I was. Now I do want to note this too. There's a couple graphs that kind of support our point here. I think that part of the reason why we're seeing these wildly different cap rate estimates is because sales are very low. That we don't have a lot to draw upon.
And the few deals that are trading are like, someone's trying to fire sale it.
Yeah. So I think and this does say that it's like in line historically, but in line historically from 2015, not from now.
I mean, we're kind of back to 2020, which was a half of a year was more than it was turned off.
Yeah. But this also, I liked this. Now we could go to FedWatch, I guess, and you are invited to go to FedWatch and look at their graphs and information about people's expectations for where the federal funds rate is going to be. Is there going to be a rate cut? How much is it going to be? In July 2nd, this is way before. Oh wow, all of a month. Yeah. So there was about 30% of the people thought that there would be no rate cut. That everything would be steady. And most, some people said 25 of vanishingly small amount thought that there would be a 50 basis point rate cut in September. Now that quickly changed, and now we're at over 50% think that there's going to be a 50 basis point rate cut, and there's no one left that thinks that rate cuts are going to stay the same. Everyone thinks that it's either going to be a 25 or and what's also worth noting in this graph here is you see that these numbers have changed even before the turmoil of early August and the recession fears and what have you.
Yeah, that's a good point.
So and that was what I was when I was talking about this, and I don't know if I said this right before or right early in our show today, is I think that the CRE market and a lot of investors are acting, and at least whether it's predicting or making purchasing decisions, they are kind of seeing what's ahead, and they are expecting a rate cut, or they're expecting at least improvement, and there's a little bit more faith in the markets. You were talking about in terms of lost opportunity, and there is like a cost that, whether it's like locking in rates or whether it's you're not making a purchasing decision. But one of the reports that I stumbled upon while I was researching here, and didn't get its whole entry, but I wanted to mention it here because it's super interesting, is they calculated the deadweight loss associated with people staying in their homes because interest rates are so high and they're not going to buy. But so what's the cost? Not of the higher interest rate payment that you would pay, but just of like, you didn't get to move now. You don't enjoy what you wanted to enjoy, and they really did a good job quantifying that.
Yeah. And how did they quantify
so
that?
they it was very complicated.
Is it's like, I'm not close to the kid's school, or I'm not close to work and family, or
exactly.
Or just, I'm not living. I don't like this house.
It was primarily on the axis of like mobility, and like I can see how that could translate to commute time, and you put an hourly rate on that and stuff like that. But I still think there's a myriad of factors that would determine where you want to live, and it's not just the mobility.
There is, without a debt, and so there's a spike of refinances. That MSCI has reported.
Oh, that number was 20 billion. 20 billion, by the way.
20 billion.
20 billion and they just took 1 year between 2022, once the interest rates got high, and 2023, and that was their dead weight loss, was 20 billion, which was a relatively small amount, but that's money that never was born. That is money that never, and even the extremely high amount of higher interest rate payments that was made, at least that money circulating in the economy. But this 20 billion is just, it vanished. It could have been, but never was, because of high interest rates.
Yeah, that's interesting. One thing is for sure is that there's a lot of pent up demand for the bare minimum refinancing. And folks are going to refinance their homes if they still have a relatively high mortgage, or if they bought a home in the last couple of years and interest rates were higher. Then we also, there's a pent up demand for people to move who have been kind of stuck over the last.
And CRE refinancing too, specifically.
And that's the exact. Not even to mention CRE refinancing and all of the whether it's construction loans, bridge loans, any floating rate loan, where that have been really that they've seen a lot of challenges, because obviously the interest rate payment is higher. If you have it capped, if your interest rate is capped, your interest rate, that's your cap replacement reserves have increased. So you're spending more money on interest, but then your interest rate is capped, so you don't have to pay any more necessarily in interest. But you have to, because you are paying the full amount. You have purchased an interest rate cap that's making a payment to you to cover that difference of what you thought you were paying in interest. But then you're having to place money into an escrow to reserves to purchase an additional rate cap when your rate cap expires. So typically these rate caps are 1, 2, or 3 years. Typically they're 1, 2, or 3 years. In the long term, maybe 5, 7, or 10. And so the agencies require you to have a cap in place, and they require you to be escrowing funds to purchase a new cap when that one expires. And so as the caps increased in cost, as they did with interest rates, all of a sudden you went from escrowing a couple $1,000s a month, and now you're escrowing $20,000.
Oh wow!
Now that's your money. It's sitting in an escrow somewhere. You're not exactly earning any interest. And you'll get it back if you sell the property or refinance out of that loan, but it's sitting there, not distributable, not affecting, it's hurting your net cash flow. But those payments, as interest rates come down, if that funds rate comes down, those cap escrows requirements also will decrease. Now, the cap payments will decrease with interest rates, but the question is, while this will be welcome news for borrowers, it's not necessarily going to. We've talked about this in the past. It's really only going to save for the folks that need saving, the folks on the margins, where they can almost pay.
That's what I was thinking.
Getting close, because 25 basis points, maybe 50 basis points over the whole year. So we're going to be going from 525 down to 5 to 475. It's better, but it doesn't necessarily put you in the same place. You're still paying 7 to 9. You're going to be still in kind of the 7% range, maybe high sixes. Most likely still in the 7.
That's what was surprising. Is some people it must be an emergency. They need that little shave of a quarter percentage point.
But it is confidence to the lenders and banks that maybe we don't want to foreclose on you. Maybe we'll give you a little bit of extra time because we have started the process of rates going down. But there then has to be a really kind of a clear trajectory of all right, how's the property doing? Are you a good borrower? We're going to have you put some more money up if you want to keep this thing afloat.
And to speak a little bit to some of these kind of long-term trends that I thought that maybe the market is tracking. Maybe that what we're looking at is a longer-term trend of lowering 10-year treasuries that have been going down since May, and that's a good 3 months. And the trajectory of lower 10-year treasury rates is actually that long-term, from May to the beginning of to the end of July. That was a lot bigger. It took longer. That was a lot bigger than the recession fear of early August jump. So the longer term trend is worth trusting, I think, because it was longer. I just tend to trust it, but it was also a greater magnitude than the recent than the recent jump. So this isn't a new thing. You can look at the mortgage refinancing increasing. It's also a slow and steady increase. So it gives me faith that there's something more to this than a knee-jerk volatile reaction.
Yeah, a lot. I mean, recovery and again, normalization has been a lot of the theme this year. But prices we talked about last week have, in the opinion of many, have bottomed and are starting to recover, and that they are doing that in partially anticipation of rates also coming down, which makes sense. We're buying the rumor, we're not buying the news necessarily, and that comes into play also with sales volumes with the second quarter of 2024, basically matching the sales volume of the second quarter of 2023. Admittedly, well below normal volumes, kind of on par with kind of first and second quarter of 2020, which were just paltry volumes as well.
And these sales volumes that we're looking at here on this MSCI article, they're reflective of global sales. So it is worth noting, and they're comparing they've got other charts with the U.S. prices, but the fact that global sales were reduced just as a good reminder that we are subject to international forces. These macroeconomic forces are not just limited to the United States. Well, I guess we didn't really need that after the yen thing, but it's not just a Japanese carry trade. Like, this is longer term stuff that everyone's embroiled in.
Yeah, that's a good point. Again, looking at this Moody's report, Matt, and a lot of this is, we talk about this, just the refinances that are starting to peak up. And again, I think we're just going to see more and more of this, where people who have, everyone who's bought real estate over the last couple of years, since interest rates are decreasing, all have said, well, and we'll refinance when rates recover.
Yeah.
And when that's, who knows? That was the question. But now it's looking as though, all right, not yet, not today, but we're entering a period where that might actually be possible.
Yeah, and I wonder too if it's connected to expectations on the 10-year Treasury, more so than like expectations on the federal funds rate. Well, and they're both correlated, obviously, but they're not thinking, that the 10-year Treasury is going to really spike that hard, because they've seen that longer trajectory and they have some amount of confidence. But yeah, I agree. That was my specific thought, was like, some people are either reaching a breaking point, or they realize, well, any decrease we're going to have, a lot has been priced in, and it may not move. I was also looking up, how often can you refinance? And I guess some lenders do have like a time limit. There's like some kind of seasoning period, but like, man, if I was,
usually it's like you have to wait a year.
Okay, because I just do it as rates are lower, just
some
on the trigger.
Obviously, cost prohibitive.
And that's what a
lot of times there's a 1 year lockout.
Okay.
And then there's oftentimes, not always, a prepayment penalty.
Okay. That makes a little sense, because that's what there was like. It's not always the case where you have to do where you really should do a refinancing because of the fees and the extra costs associated with the refinancing itself. But there's also like, they're not going to let you do it every day if it's 1% lower.
A lot of work.
Yeah.
And there's fees and But a lot of people are looking at, the question is, if you increase your net operating income, what are values like, and then what's your interest rate? Because if you get your, they're all looking at, loan to value and your coverage ratio.
So then that's a good point, and that was a big question I was thinking of. And this is a little getting into the weeds about refinancing, but like, it's some serious reporting that and data gathering that you're going to have to do to present to the banks, and like, show them the net operating income, all the different categories, and they look over it.
Last piece today, Matt. The National Association of Realtors has a piece, Commercial Real Estate Market Insights for July 2024. They break down a couple different asset classes, starting with office. Not looking too hot, no surprise there. Maybe not apocalypse, but not great absorption, that's for sure.
I liked this report because it's a good reminder that the apartment market is within a larger, a larger area of the economy that's commercial real estate. Last week we did kind of compared it to the stock market, but I think that at the very least the CRE market is roughly correlated. We saw a lot of these graphs for commercial real estate prices. They're all kind of rising, or at least the rate of decrease is decreasing. So they're all kind of rebounding, even office.
Yeah, I mean, positive absorption Q2 of 24.
Yeah, so that graph says positive, but then in their paragraph, they actually say that the second quarter saw negative absorption. However, it was fewer additional unoccupied spaces. So that may be what's reflected. Even so, I guess I can trust what's in the paragraph more than the graph. I'm not sure what the hierarchy is there. Yeah, that's a good point. But needless to say, I think that it's like the assessment of the office market is it's not doing great by any means, but it at least is not spiraling.
Maybe, the bleeding has stopped, and now it's just as those longer term leases roll over the next many years. What will that look like? I am not in the camp of saying that like offices is going away. I think that obviously the values are down. I think there's some opportunities probably in the office space. It's not an area that I want to get into because I like multifamily a lot better for a lot of other reasons. And there's a lot of potential for upside. But I would not write office out just yet. I would not count them out. And if you're in the office space, I'd be looking for some opportunistic opportunities. Getting some, folks, businesses still need a physical place to meet and operate.
And what has been, what a common article that I do read is like people like the nice offices. Those are still in high demand.
Yep. If you're gonna have a space, might as well be nice. If you don't need a nice place, just stay at home.
Yeah.
Multifamily, though, is saying, in contrast, the multifamily sector continued to gain momentum with mortgage rates, increasing near 7%. But in the second quarter, net absorption was 2.4 times higher than a year ago,
Crazy.
with an additional 260,000 multifamily units leased than vacated. 260, just to repeat, 260,000 units leased rather than vacated. Demand was also 44% higher than the pre-pandemic level. However, despite this strong demand, the record number of new multifamily units delivered to the market kept the vacancy rate steady compared to the previous quarter and higher than it was a year ago. So really strong absorption, people wanting to be in apartments, signing leases. We're just delivering so many damn apartments that it's not making the vacancy numbers budge. But holy hell, man, got a lot of people that are moving into apartments with the top rent growth, according to NAR, for Q2 in Lancaster, Pennsylvania, followed by Evansville, Indiana, home to several great capital properties, Springfield, Massachusetts, Louisville, Kentucky, Syracuse, New York, and Youngstown, Ohio. These are smaller markets, not always covered in some of the larger rent reports. So it was nice to see this list in a way. Nice to see the Indiana market take the number 2 spot.
They did really well represent the contours of what's happening in the multifamily market and where it kind of is headed. If you understand that the amount of new apartment supply is a finite thing, like that, the wave has crested, and we're not going to see increasing amount of newly built apartments. It's going to always continue to go down. Measure that against a burgeoning, if anything, growing amount of apartment demand. That's a really good environment, and that could make you feel a little bit.
It goes to show that sales solves almost all problems.
Okay, wait, please explain.
Well, in business, not that you don't need to master every part of the business.
Yeah.
But just about any problem can be solved with more sales.
Yeah.
And in this case, the problem is too many multifamily units. Well, what's the way you can solve that? You lease more multifamily units.
You're right. It was too simple for me to understand.
It's super simple, but like sometimes the simplest, simple things are like, people are like, why do we need more salespeople?
Yeah.
Why are the salespeople compensated the way they are? Why do the salespeople make money? It's because they'll fix all the problems. You can only save you need to save money. You have to watch your finance, watch your budget, but you can only save so much money. Because there's a certain amount you have to, whether your home or your business, keep the lights on. You have to keep operating. It becomes much less of a problem if your sales are growing at a much faster rate than your expenses. So in bare minimum, increasing sales, in this case, increasing leasing activity, absorption rates has basically made the increase, downward effects of new supply really minimized. Now we're not seeing strong rent growth, but we're seeing positive rent growth across the country. We're seeing basically occupancy settle down to a relative historic level maybe slightly less, but we're facing unprecedented new supply.
Yeah.
We haven't delivered this many apartments in over 40 years. It doesn't mean that markets like Austin and Atlanta and maybe Huntsville and Salt Lake City and a handful of others, Phoenix, ton of new supply, negative rent growth, but they will grow out of it also. They just need more sales.
Yeah, that is a good point. And I do think a little bit of the increased demand is a kind of a snapback from a sluggish 2023, but we're seeing a lot of sales, all that absorption. That's one sale each, kind of.
Yeah.
And that's a lot more. 44% more than pre-pandemic average is a heck of a lot, and it's not going to go away that quickly. I don't think there's no real indication that it will.
The reality is, it has never been more. It's never been more affordable to rent an apartment compared to buying a home. Which again, that flies in the face of conventional wisdom and understanding.
Yeah.
And we've had some comments recently being like, "Yo, I think it hasn't rent grown like 20% over the last couple of years."
Mm-hmm.
Yes, but it's also cheaper than it's ever been in the United States to rent an apartment compared to buying a home in a mortgage. And so again, you have to live somewhere. Whether that you can live with your parents, you can live with roommates, and a lot of people are still living with their parents. We looked at that study a couple of weeks ago. But also, less people are living with roommates. People want to live on their own, unless they're going to live in with their family. Apparently,
those are big decisions too. And the 244,000 or however many the absorption number is for the quarter. That's also individual decisions to that I can make it out on my own. And this may not be like a household growth number, but it is these are new apartments rented. These are people that have the confidence to move somewhere new, and there's got to be something in there that represents a growing amount of people that are able to get started.
Good on you, millennials and Gen Z, getting out there, being a little more independent.
Yeah,
that's what we like to see.
So I was almost about to skim over multifamily because I was like, well, it's doing well in all the ways that we know, but I think it's worth saying it again because we are seeing month after month in report after report signs of the continued resilience of the multifamily market.
Yeah. Now, so we don't pass over some of these other asset classes. We talked about retail, or we talked about office. We talked about multifamily. Let's just briefly talk about retail as well. I didn't realize this, man. Retail is super tight. Inventory is super tight. There's very little space available right now.
It is weird. Like it says since the end of last year, only 4.7% of retail space is currently available for lease, marking the lowest level on record. However, it does seem like the net absorption is stable, if anything, maybe slightly going down overall. That is almost certainly a product of lack of space, maybe. They say that new construction deliveries are decreasing. No one's really building any, and things are tight. And
I don't think restaurants and nail salons are going to go away anytime soon. Man.
Yeah. Industrial was the one that I thought was the most interesting here because that was the kind of the darling of the pandemic. I don't know about apartments, kind of bias there, but it always did seem like the cool kid on the block was the industrial real estate.
So they don't have, because they're getting good returns, and they also don't have to deal with some of the headaches that we do in property management.
Yeah, and it did seem like it did like
you have to work with Amazon.
Yeah,
You got one tenant, you give them the box, triple net. Here you go. Let me know if the roof caves in.
The good life. That being said, this current assessment
until Amazon says we're not leasing any more properties and you build a bunch of spec.
And that's
which they're back in the market.
Well, it almost seems like that is the case here, at least in terms of NAR's assessment of things. They're not really saying that industrial is the cool kid on the block. They do note, they say, while demand for industrial spaces was reached record high levels at the end of 2021 to 2022. Absorption is now 64% lower than a year ago and 53% below pre-pandemic average level. I always think about how some of these reports will toss a few positives in with the negatives, but to kind of sum up the takes here on in this NAR report, industrial seems to have the harshest. They
Yeah.
say, at the very end, they say, with consumer spending shifting away from goods to services due to high borrowing costs, demand for industrial spaces is expected to ease further in the coming months. This outlook suggests additional softening in this sector. Softening is at least a friendly word to say, but it's a hard road ahead.
Everyone's already got everything they need from Amazon.
Yeah, I guess so, man. But things will break soon, sure.
No, I think that my gut is that industrial is going to have a good decade.
Yeah.
I just think they grew a ton, and
that's a really good point.
A lot of speculative development was taking place.
Because other sources are talking about the reinvestment in manufacturing. That's a longer term, decades long story that will play out. There's a lot of interest in building it. What is it called? Reshoring. Yeah. And those are slow, sometimes government funded, sometimes slow, but they're coming back. And we spent, this was a couple months ago, we spent a whole episode going through all the big places that are happening in the Midwest, just specifically. But there's other places, data centers. I don't know, is that technically industrial, or
it's its own thing, sort of. It's its own asset class. I don't know if. Now, I could be wrong. Maybe they are including data centers and industrial or office. I don't think they're really included in either. It's kind of its own group.
And that I needed to ask someone that I wonder how much of industrial is warehouses versus kind of manufacturing and whether
like
that
logistics
versus
logistics
manufacturing
versus manufacturing. I mean the big the popular thing to build has been logistics centers.
That's what I was
thinking. But certainly, and the manufacturing is a little bit more bespoke at times. So you have to kind of go out and really build your own specific needs.
You get like the 240 volt, probably.
Probably some 3-phase.
Exactly. That was in factory.
I was in. But the logistics centers can be a little bit more like speculative. Kind of build a big box, kind of know what the ceiling clearances need to be, and you build it. They were coming. Now I think there was a slowdown. Amazon was out of the market. Now they're back in the market, according to folks who know in the industry. But just again, the article's saying ship goods to services, but I think that the adoption of e-commerce still has some room to grow. I think adoption was accelerated during the pandemic. I think maybe that's by development. That's why it got over its skis, because how much adoption, the adoption rate, that's probably leveled off. I'm assuming.
And I don't think that there's a whole lot of, like I say, people willing to roll the dice now, especially. So I'm sure that industrial development is reduced as interest rates are higher.
I'm surprised I don't. This is related.
No, that's fine.
I'm surprised. We're not seeing more drones just flying around delivering stuff yet.
I know.
I think that's coming. I don't know what's holding it back, but there's gonna be a lot of new different facilities needed to start doing that kind of transport. Because I was looking at the sky. I'm like, I'm surprised I don't just see a couple drones just buzzing around. They're hard to see sometimes.
I know.
But let's stop our drone conversation.
I don't know. It gets scary. I always think, in the future everyone's gonna have a drone orbiting your head to protect from the dangerous drones.
Well, I was thinking about that. Yes, how do you repel the dangerous drones?
Yeah.
You have some sort of like EMP bubble shield.
A net gun. It's gotta be
Ukraine. That drone warfare.
I know.
Is frightening.
Yeah. And because that's when you said that, I'm surprised there's not drones flying. It's a little unnerving when you see them kind of buzzing by. Yeah. I think a net gun is mine.
You're reading my thoughts, man. I was thinking about net gun also because they've got the EMP sort of where the jammers. But again, you've got a drone with a grenade attached to it. It's coming at you.
Yeah.
I'm shooting the net gun and the props.
They're thousands of dollars, but
the net guns.
Yeah.
Okay. Well, we have veered off topic slightly. Thank you for watching this episode of The Gray Report. Make sure you subscribe to the Gray Capital YouTube channel. And there's a little bell icon. If you smash the bell icon, not that hard, just break your computer, just like we broke this keyboard. But then you're going to get updates on when we post new videos, not only for The Gray Report, but also The Complex, hosted by Katrina Green, Director of Property Management here at Gray Residential. She's a great episode with Bronte McLean, really getting into what she's been doing on a day-to-day, working with individuals, helping to avoid evictions and reduce increasing collections at our properties, but working one-on-one with residents. We're talking really kind of at the macro level, interest rates and drones.
Yeah. Stay for the drones. Come for the multifamily. Stay for the drones.
But they're really getting on a really blocking and tackling what it takes to run successful multifamily property. So check out the complex. Make sure you subscribe. Leave us a comment. Tell us stop talking about drones during the real estate podcast or more off-topic conversations, which maybe we need to have just a different segment. All right. Catch you on next week, everybody. Thank you.